Hello, guys. My name is Anish Lakapragada, and today I thought this would be a great time this week to talk about dividends and how yield works and all of that good stuff, and also take my personal spin on it while teaching you guys about dividends and yield and why I think it's personally overrated. I know YouTube and the internet tends to make dividend investing this kind of holy grail and all investors should abide by, but I personally think it's just a bit overrated. So, without further ado, let's just hop right into it. Hang tight, this will go really fast. So, before I even talk about dividend investing and why I don't think it's that great, let's just define the terms real quick because I don't want to be saying these terms and you don't have any idea of what they mean. So, a dividend or dividends, it's an amount of money that's paid to shareholders or people that invest in a company or the company stock to incentivize investors to invest in the company stock. So what that means, I'll just summarize that, is it's saying something like, hey, if Apple says, hey, I want you to invest in my company stock because if you buy Apple or AAPL, then you're going to be giving me that money and I can use that money to grow my business, which will help me after all. So then Apple may say something like, I will pay you just in gratuity a dividend of $1 per share, stating that if you buy my stock right now, I'll pay you $1 per share annually. For every share that you own, you'll receive $1 in the mail, and that's just as a sign saying, thank you, we appreciate your investment really helps in this company and growing the company. So that's what a dividend is. It's an amount of money that's paid to shareholders, usually annually, to incentivize those investors to keep on investing in the company stock, to buy more shares. And dividends are measured by the shares that you own. So, for example, a dividend of $2 per share would say for every share you buy, you get $2 as a thank you and gratuity. Dividend of $1, $1 per every share as a thank you note. So that's what it is. A yield is the amount of dividend that you get, or like how much money you get paid per share, divided by the current share price. This is used to keep things in proportion. So I'm gonna exit out of the slides. And we're gonna go to Morningstar. So Morningstar, this is an investment research center, very nice resource. We're looking at Walt Disney Company stock DIS, and here the current price is 85.98. So yeah. And its dividend yield, don't worry about forward, that just means from now on, is 2.05%. What that means is that the dividend that you are paid per share is 2.05% of the current stock price that is 85.98. So if we wanted to find out how much we would excuse me, if we wanted to find out how much we would be getting paid for if we want to find out how much we're going to get paid for every single share that we own or the dividend, we would just have to do 2.05% of 85.98. So, like this. All we would have to do is go AC 0.0205 times 85.98. So, a second about that. Finally we got the right answer. So you would get paid roughly like 1.76 dollars per every single share you own. That's the dividend, and 1.76 is 2.05% of the 2.05% of the current stock price. So yeah, the average yield in the stock market is 1 to 3%. Anything higher than that is qualified as fair game for dividend investing. Now, before we define what dividend investing is, always remember that if the yield increases, there's a huge chance that the stock price, sorry about that the stock price has decreased. Because think about it. If the dividend stays the same or the amount of money they're paying you per share, but the current share price drops, then that means that the denominator is less and therefore the yield is going to increase. So therefore, a lot of people when they dividend invest or when they invest in companies that have these huge dividends, they just run a simple scanner on Morningstar or whatever they like to use, Thinkorswim, that says, "Find me dividends that pay 10% or higher." We've all done that at some point at a time, and dividend investors they do this a lot, and then they blindly invest in those companies. However, here's why that's not a good idea. If the stock price keeps on tumbling, then that means the yield is increasing. So it's not really worth yeah, it was saving the penny, but losing the dime. That's pretty much what I'm saying. It's not worth buying a stock that has low growth just so you can make a little profit on the dividend. Don't don't be penny pinching, but then lose your dollars. Is what I'm trying to say. So I kind of covered it already. But dividend investing is buying stocks that pay high dividends and high yields, greater than 2.5%. And you're buying the stocks only for the dividends. You're not buying the stocks for the growth that they provide in the stock price. You're buying the stocks only for the high dividend yields and the passive income that they may provide for you. Now, when it comes to growth investing and dividend investing, the two types of terms in terminology you are bound to encounter is growth stock and dividend stock. So I just want to define that right here. So we're in the Apple stocks. Hopefully the Wi-Fi can. Yeah, we're in Apple stocks, and let's look at a growth stock, Amazon. So Amazon, this is a growth stock as far as the stock price is concerned. It's been growing, and it seems to have no signs that it's going to stop. It's just continually growing up, and it's hit 1,000% returns, continually just going up. So yeah, it's a growth stock. Not much to talk about there. A dividend stock would be something like Philip Morris. Now, before I show Philip Morris, PM, I just want to point out here, Amazon having the sublime amount of growth pays no yield or pays no dividends. So just keep that in mind. So you don't necessarily need companies that don't pay dividends aren't as good companies as well. And I'll go over why that is soon. So this Philip Morris, this is a cigarette company. Don't smoke, kids. Keep that in mind. And here we can see this is the all section. Not very impressive growth, really. Just from its IPO initial public offering to what it is right now, it's only gained $10, and that's not even close to being impressive. Yet it gives a yield of 7.05%. So this is clearly a dividend stock. It has an abnormally high yield that's greater than 2.5%, well greater than 2.5%. But its stock price and the price trending movements are mediocre, to say the least. So the key reason why I believe that dividend investing isn't as good as growth investing or just buying stocks that tend to have higher growth is that dividend stocks tend to have low growth. Now, I want to point out here that we looked at Disney, right? This is Disney, DIS. I'm just going to show it. And here we can see clearly, yeah, it clearly has some really high growths. This drop, by the way, is only because of coronavirus. Or not only because, but that's a huge reason. And here we can see that it's clearly a growth stock, yet it still gives a dividend. So I'm trying to simplify this for you. This is just because a stock gives a dividend does not necessarily mean it's a dividend stock. There's tons of stocks like Disney that have this huge amount of growth and still give a 1.85% dividend. I'll go over why growth stock gives dividends and why dividend stocks give dividends and the difference between them later on. But for now, I just want to tell you guys that whenever you're looking at a stock, the signs that you're dealing with the dividend stock is that it's in older industries like internet companies, oil and gas. Now I know you guys may be thinking, oh wait, I thought you said Amazon was a growth stock and it's an internet company, right? No, when I'm talking about internet companies, I'm talking about telecommunications and .com, that kind of old stuff, like the kind of stuff that Cisco does and Juniper, Maxim, what they do. So here we can look at Cisco. This is clearly a dividend stock with a nice yield of 3.82%. Now, one thing you'll notice is that it's pretty matured and it has a central revenue stream that's not changing. As we can see here, Cisco is mostly focused on selling routers. And the .com and the telecommunications, when all of that, during that bubble, that boom and burst, Cisco was at the forefront. That's why we see this huge dramatic stock price trending up in the 2000s. But from there on out, it just went mediocre, and Cisco has just streamlined its business model to routers and internet services and whatnot. It has a huge market cap. It's a big company, $151 billion. That's how much it's worth. But right now, Cisco, since it's really matured and it's a dividend stock, it's more focused. This dividend stock and countless others, they're more focused because they've already peaked. They're more focused on giving money back to the shareholders via dividends rather than keep on trying to innovate. Cisco has already had its peak, so right now All it's doing with its high yield is just giving money back to dividends, back to its shareholder, giving dividends back to shareholders. Sorry, and just paying back to people who invested in Cisco in the first place. Whereas other stocks and other growth companies don't tend to have that high dividend yields. Amazon has a dividend yield of zero, zilch, nada, whatever you want to call it. It does not give any dividends out because it's not done innovating. Now, some other older companies, there's like oil and gas, like CVX, Chevron Company, 8.99% yield. But if we look here, look at how low the profit is. Like from 2003, oh, one second, my Wi-Fi is bad. 2003, it's only gained $26.15. We can also look at some other stocks like PFE. This is a medical company. PFE, yeah, it had its growth here, but then the growth just kind of stopped, and it's not very impressive, and it's pretty mediocre from there on out. So that's one thing. It's already had its peak. So that's one sign of a dividend stock. And obviously, the most important and the most obvious is that it has a high yield and it gives a high dividend. That's what makes it a dividend stock in the first place. So if you're not convinced now that investing in dividend stocks is not as good as investing in growth stocks in general, let's look at one case study of Apple versus XOM. So this is Apple. XOM is ExxonMobil, by the way. This is such a good growth. From the 1980s all the way, it keeps on going up. Now, Apple is still innovating, it's still making new products, and it's still at the forefront of technology. I know a lot of articles are written against that, but just bear with me, and because as far as the stock price is concerned, Apple is still at the forefront of innovation, and Apple is still innovating because the stock price keeps on trending higher and higher, and there's no sign of it stopping soon. Meanwhile, we can look here. Now, I'll look here to XOM or ExxonMobil. Now, before I show you guys ExxonMobil, keep in mind the dividend yield is 1.26%. We're going to come back to that later. This is ExxonMobil, an oil and gas company, a huge behemoth with almost worth $139 billion. If you invested here, you would and held it until right now, you would have an 84 cents profit to show off. That's not even close to mediocre. That's like below mediocre. That's terrible return in the stock market. That's just pretty much dead money, and that's wasted money in this, that you could be investing into other growth companies like FANG stocks like Facebook, Apple, Amazon, Netflix, Google, Microsoft, those more higher tech industry leading companies. But here we'll see that its yield is 10.11%. 10.11% of 32.74 is like 3.2 or 3.28 or something around that neighborhood. But there's no way you can convince Pete that if you held the stock from here to here and you kept on collecting your $3.2 annually, and you had to show off your whole 84 cents profit, you would definitely not be making as much money as someone who invests in Apple at the same time frame. Look here, 2002 to here, 228.19, and the yield only adds to that amount of money. This is the reason why I believe like growth stocks at its core are so much easier, so much just more straightforward and reliable to depend on rather than investing in dividend stocks. Now I know the key reason why people invest uh, in dividend stocks is that they can take those dividends and then reinvest it back and back again, and this will lead to a vicious snowball effect. However, keep in mind that if you're reinvesting dividends back into low growth companies, that's not very smart. You could instead be reinvesting those dividends into higher yielding companies or companies that have a higher growth rate rather than dividend stocks. Remember, if you reinvesting dividends is only smart if you're reinvesting dividends into companies that have high growth. If you're just continually reinvesting dividends and reinvesting that money that you get and then buying more stock from that dividends, and it's a low growth company that's not going to do as much for you than just reinvesting the 1.26% you get from Apple annually back into the company, and then this will lead to a snowball effect that's good. Now, obviously, everyone wants their money to work harder for them at the end of the day. So why wouldn't you choose growth investing? It's just so much easier to make a stable profit over the long term, as we saw with Apple versus ExxonMobil. It's clear that Apple wins and takes home the cake. So yeah, just keep in mind, dividend investing, it's good, solid, but it has its place, and its place is below growth investing, which is the easiest and the simplest way for you to make a nice profit in the stock market. So yeah, please comment, please like, subscribe, share, do whatever you guys want to do. If you have any feedback or any other topics you guys would like to talk about in future videos, drop them in the comment section below. Anyways, thank you guys. Really appreciate it.